Trading Room Live. My name is David Hickson, and it is the 2nd of November 2015. Before we do anything else, I would like to inform you that next week's webinar won't be happening the 9th of November. And so please make a note in your diaries. I don't want to disappoint anybody and have you arrive and find there is no webinar on the 9th of November. There will not be a Hurst Trading Room webinar because I will be traveling, but I will be back on the 16th of November, so please make note of that. And as always, before we take a look at the markets, please make sure you have read and understood these disclaimers. Let's take a look at the markets. As always, if you have any questions, please do type them into the chat window and I'll do my best to answer them. First of all, I am planning to speak about gold in today's webinar because we are sort of going back over our instruments that we have been looking at in the webinars, and I'm going to update the analysis on gold. But before I do that, I want to quickly take a look at the S&P 500 or the ES futures, and that's because somebody made an interesting comment on one of our blog posts. I think it was a blog post that I wrote last week, asking whether it was possible that the trough in September, at the end of September, whether that trough might be a trough of the 18-month cycle or the 40-week cycle. So let me just quickly show you. Of course, this is the default analysis that Sentient Trader has been showing us, and let me just quickly change that to daily and zoom in a little bit and show you what the discussion is about. Here is the default analysis, and let me just drag that window down a little bit so you can see it all, and turn off the semicircles, which get a bit distracting. Okay, so the default analysis has an 18-month cycle trough over here in October and a 40-week cycle trough in late August. And we've been looking at what's been happening since then, and we had a very sort of neutral shaped cycle which bounced up and came down again towards the end of September. And since then, the US markets have really switched, and we've seen, tremendous enthusiasm in that big bounce upwards. In last week's webinar, I discussed the possibility that this alternate might be happening, which is that, let me turn off that composite line before we get distracted by it. Just reset that. This was the alternate analysis that I presented as a possibility, which is that the 40-week cycle trough occurred at the beginning of July, and that big, really prominent trough over here at the end of August was only a 40-day cycle trough, and that price then came down at the end of September to form the 80-day cycle trough, as you can see from that stack of diamonds over there. That's the 80-day cycle of marker, and the price has been bouncing up strongly out of that 80-day cycle trough. So that was the alternate analysis that we looked at last week. I thought I would just quickly start this week's webinar by throwing another iron in the fire, or cat amongst the pigeons, or whatever you say, and that is that possibly the trough that formed at the end of September was not a 40-day or an 80-day cycle trough, but was the bigger magnitude trough, the 18-month cycle magnitude trough, which formed at the end of September. And that is, of course, a very possible alternate. And let's speak for just a few minutes about what the implications are. I see Jorge saying hello. So let's quickly discuss this. First of all, how did I get Sentient Trader to do this? Well, you can see the pin symbol. Let me zoom in here. You can see the pin symbol next to the 18-month cycle trough. That tells us that I have pinned trough there. In other words, I told Sentient Trader that I want to position the 18-month cycle trough at that position, and Sentient Trader has obliged. It has positioned the 18-month cycle trough there. In order to do it, Sentient Trader has done some really rather odd things. One of the things that it's done is it's displaced that 40-week cycle trough over there. Why is that? It's because when Sentient Trader performs an analysis, it tries to perform a perfect analysis, and it breaks down all the cycles into smaller and smaller increments. A discrepancy whereby it has a 40-day cycle, perhaps, which is clearly much too long, as is the case over here. There's the 40-day cycle marker, and here is a very long 40-day cycle. It's much too long for a 40-day cycle. Then what Sentient Trader will do is it will sort of fudge the lines a little bit, and it will shift some of the troughs forward in order to try to give you the analysis that you've requested, which was this 18-month cycle trough over here in September. I don't worry too much about that. I believe markets are not perfect, and one of the problems with approaching an analysis using a computer and a software application is that the computer wants everything to be perfect, or the software wants everything to be perfect. As an analyst, I know that the markets aren't perfect, and I know that sometimes there are discrepancies in an analysis. The markets are the result of human activity, human emotions, which are generally very far from perfect most of the time, as you're probably aware. And so what we're trying to do is we're trying to fit a sort of a perfectly accurate model on price action that is not perfectly accurate. And so the way that Sentient Trader accommodates that is it does things like sliding this 40-week cycle trough over. I don't let that bother me too much. And what's more important is that this is a possible analysis. It is possible that the 18-month cycle trough formed here at the end of September instead of at the end of August. Now, there are two things that happen when a trough is formed. I see a question from Paul. I'll get to that question in a moment, Paul. Let me just finish this train of thought. There are two things that happen when a trough forms in the market, and you can see it here on the left of the chart. First thing that happens is the price drops down into that trough. That is what some Australian beta testers of the Hurst trader or Sentient Trader call the plunge, and so I've stuck to that term. That's the price plunging down into the trough, and then of course you get the bounce, which is when price bounces out of the trough. And if you look at most of these troughs in the analysis, you'll see very clear examples of nice, simple plunges into a trough followed by bounces out of the trough, creating that V shape, of course, at the time that the trough is formed. Sometimes, however, something goes wrong, and it either goes wrong on the side of the plunge or on the side of the bounce. And what has happened with trough in August and September is actually an example of the markets not behaving perfectly. And so let me show you what I mean. Here we have a very strong plunge. Can you see that? It was only about a week long, but we had a very strong plunge down into that trough in August. What you would usually expect, if that was a big magnitude trough, is you would expect an almost symmetrical bounce out of it. Well, you can see that we did get a bounce out of it, but in fact the bounce came 40 later. And you can see I've simply displaced my illustration of the bounce by 40 days. So there it is. It's that much later. And what we had in between was this anomalous neutral shaped 40-day cycle. Now, this is something that I have observed many times over the years that I've been trading with Hurst cycles, and I can't explain it, is the honest truth. I don't really know why it happens, but here you can see we got a fairly neutral shaped 40-day cycle with a trough that was really very close to the point, and you have two equal peaks. It's the perfect example of an M-shaped neutral cycle. The question is, did that neutral 40-day cycle shape, did it occur after the formation of the very big magnitude cycle trough, either 40 weeks or 18 months, or did it occur before the formation of that trough? And so this alternate analysis that I'm presenting you today assumes that the neutral shaped cycle occurred before the formation of the trough, and the cycle trough actually occurred, as you can see on this chart here, actually occurred at the end of September. So that is the trough that we should be considering as the 18-month cycle trough. It is perfectly possible. It's reasonable. That trough formed slightly higher than the trough in August, as you can see. So strictly speaking, the trough in August was a deeper trough, but we're really splitting hairs there. This was a very emotional week. I don't know if you were trading the markets during this week, but the markets fell sharply and they just kept falling. And so there was a lot of emotion, quite a lot of panic. And of course, when people are panicking like that, price levels will tend to be overshot. And so the difference between the level of this trough in August and the level of the trough in September, I don't think we can really argue too much about it. The point is, this is a possible alternate analysis. And Bob's question, I haven't forgotten your question, Paul. I'm going to come back. Bob's question brings me to my next point. Can viewing the composite model help to legitimize the alternate? Exactly. That is one of the benefits of the composite model line. Just a reminder of what the composite model line is. The composite model line is Sentient Trader takes all of the analysis information that it has. It takes all of the cycle information that it has as a result of the analysis that it has performed, and it puts that information together, and it basically says, or it states that, you know, if it didn't have the actual price movement, but it just had the cycle information that it has, and it reconstituted or recomposed all of that information into a model of what the market was doing, then this would be the result. And we call it the CML, has become known as the CML composite model line. And so that composite model line can be used in two ways. The first way that it can be used is you can see how accurately the analysis that Sentient Trader has performed actually reflects the price action, because Sentient Trader is taking the cycle information and recomposing it. And where price moves at odds with the composite model line, that indicates that the analysis doesn't reflect very accurately what actually happened in the markets. So there's an example of this over here. And the reason for that is fairly clear. It's because of that displaced 40-week cycle trough that I mentioned earlier. Because that 40-week cycle trough has been displaced to the right in order to accommodate a cycle trough over here, and not exceed beyond normal parameters the lengths of any of the shorter cycles. It's done that, and as a result, our cycle model is at odds to the price movement during that period over there. The rest of the time, I think you see the composite model line actually follows the price action fairly closely. Not very closely, but it follows it fairly closely. So Bob's question, the composite model line could help us to legitimize the alternate, but it's a bit of an art. You know, there's no clear black and white. This is definitely the better analysis. Let's compare this analysis with the other analysis that really directly relates to it. And let me just zoom in. I see a whole lot of questions. I'm going to get them. Let's just finish this discussion about the composite model line. Okay, here is the composite model line. All right, here's the composite model line with the other analysis. And as you can see, this composite model line started price started the cycle information that we had indicated that the market should have been much higher back here in March, and over here even in January, and it even started disappointing last year in September. Price simply didn't rise as high as the composite model line indicated it was expected to, purely because of the cycles. However, recently we've seen a divergence in the other direction. Price has been bouncing up higher than the composite model line. So there are a few things there that just don't really seem to make sense. And if we go back to our alternate analysis that I'm speaking about today, I called it a weak plunge, and let's just try and zoom out and get roughly the same scale so that we can compare those. I think you can see here that this composite model line looks better. It did start disappointing a little bit over there and a little bit over there, but this composite model line looks closer to price. The model line is closer to price. Generally, that's an indication that perhaps this analysis is a little better. In particular, you will notice that this rise from September's trough over here is matching exactly what our model line shows us we should have been expecting. So in other words, this big rise that has happened over the last month or so is not really a surprise given the cycle information that we have as a result of this analysis. And that's really the important point. Okay, I see lots of questions. I'm going to come back and get to those in one moment. Let me make one more point about this. If this analysis turns out to be the correct analysis, then this strong move that we're seeing now be expected according to this composite model, according to this cycle information that we have, might be expected to continue up until this peak, which, as you can see, is in January of next year. Now, if you were watching the webinar 2 weeks ago, then you will know that pretty much all of our analyses were saying that January of the year is a time that we need to be watching for, for a big peak in the markets. Let me take a look at the composite model line according to this analysis. And of course, my scaling isn't quite the same, my zoom level isn't quite the same, but here again we have a peak in the composite model line over here, which, if I can draw a whitish line over there, is also in January of 2016. And let's take a look at one of the other alternates. We've got a few that we're watching. Here we go, this alternate. This alternate has the most disappointing upwards move in the composite. But again, the peak in this line is in January of 2016. So although we're looking at different analyses and different composite models that have resulted from those analyses, they are indicating different degrees of bullishness at the moment. But January of 2016 is likely to be a time that we need to be looking for a peak. And that for me is the really important point about this. Let me go back and start answering some of the questions that you've been asking. Paul, very new to Hurst cycles. Welcome, Paul. I hope you find them as fascinating as I do, and many of us do. Can Sentient Trader draw nested in real time? Yes, absolutely. Sentient Trader, there's an intraday version of Sentient Trader that will receive live data, and you can plot all the way down to 1 minute bars. And yes, it will update its analysis with every new completed bar, and so every minute it will update its analysis, and it will do what you're seeing here. Of course, here we're looking at daily charts, but it will do this all the way down to the very fine detail of a 1 minute chart, and it will indeed work out the nested channels. We had a little bit of a discussion last week and before we went on air today about intraday cycles, and a little comment I'd like to make there. Some of the new developments in Sentient Trader work with a dynamic nominal model on the intraday level. It's quite a new, exciting development in my opinion. One of the problems, particularly when you're working intraday, is that are tempted to get down to shorter and shorter details. Let me give you an example, and I'll use the end of day example to explain this. When we were expecting this 18-month cycle trough over here, we looked at the breakdown of the shorter cycles. So from this cycle trough over here, we looked for the next short cycle, the 20-week cycle trough, then the 80-day cycle trough, then the 40-day, then the 20-day. And you look at shorter and shorter cycles. One of the problems with doing that is that as you get closer and closer to the trough, you counting shorter and shorter cycles, and to take it to absurd level, to the point where you're counting your 15-minute cycles, trying to get the timing perfect on that 18-month cycle turn. Now that is a sure path to madness, because as you get to shorter and shorter cycles, there's more and more random noise, and identifying those cycle troughs becomes more and more difficult. And there's a big danger that you start counting all those cycles until you've built up the perfect analysis, the perfect picture, and you're saying that the 18-month cycle within the next 15 minutes. Well, that's clearly absurd. So at some point you have to loosen the reins a little bit and accept a little bit of noise and a bit of uncertainty. And that's what the dynamic nominal model does, is it allows it gives the market a little bit of room, so it avoids getting too overcomplicated about counting those shorter cycles. I hope that answers your question. Sentient Trader does draw nested channels in real time. You said nested channels. Yes, Sentient Trader does draw the channels as well. I hardly ever use the channels, to be honest. Where are they? Channels. Here we go. So here we go. We can draw the nested channels here on this chart. So there are the nested channels. You can do it on an intraday base as well. There are the nested channels. It does get to the point where you've got so many lines on your chart you don't really know what they all mean. But there are the nested channels that you can draw with Sentient Trader, and you can do it on an intraday basis as well. Okay, let's see what other questions we have there. Bob, composite model line. So I spoke about that. Greg, what is the target release date of the composite model line? We are testing it. Greg, our target release date is before the end. Personally, I was hoping before the end of November, but I think we're aiming for a Christmas release. Our beta testers have been hard at work and have uncovered lots of nasty little bugs, so we are working very hard ironing all of those out. But I do hope by the end of the year we'll have the composite model line of everybody. If you are a Sentient Trader user, and I think Greg you might be, if you are a Sentient Trader user, then just send Sam a message. Oh, I see Sam has already answered the question. Okay, try and keep up, David. All right, Robin, expert model, Dave, move that 40-week trough. Okay, so Robin, I didn't use an expert model. For those of you who don't know what an expert model is, there are two ways of influencing Sentient Trader's analysis. The one way is to simply pin the trough, and that's what I did over here. Was I simply pinned the trough, and you pin the trough by double-clicking near the trough, and then you can see it pops up a little line, and it says, "I'd like to move this trough." Well, it doesn't say that, but that's what it's doing. And then you can right-click and you can pin that trough there. Okay, I don't want to do that because it's going to really affect this analysis. That's the easiest way of influencing Sentient Trader's analysis, is to simply pin a trough. And I must decide, developing plugins, Hurst cycle plugins for a big range of trading platforms, and I was playing around last week with the MetaTrader 4 trading platform, and pinning troughs on the using the MT4 plugin is really fantastically easy, and I was having a lot of fun doing that. You literally just click it and drag it, and you've got a new trough position. It's really wonderful. So the other method of influencing the analysis in Sentient Trader is to build what is called an expert model, which is a little bit of a complicated process, but it will enable trader to really break the rules in terms of stretching, your cycle wavelengths and that kind of thing. So if this displaced 40-week cycle trough really bothered me, which it doesn't, but if it did really bother me, then I would build an expert model as who asked that question? As Robin suggested, I would build an expert model and use that. Building an expert model is a way of really making sure that Sentient Trader does give you the analysis that you want. But I won't go into more detail about that here. Jorge, I have 2 short failed entries. What would be the confirmation using Sentient tools? Okay, so that's a great question. Let's work with a different analysis and let's keep looking. I do want to get to gold. We're going to get to gold soon. Let's take a look at the 18-month cycle analysis. Okay, so trading using Hurst cycles. There are many different ways of trading using Hurst cycles. There are many different trading methodologies. Let me say that first of all. So there are various sort of aspects to Hurst cycles. The one is the analysis. So you form the analysis, which positions these diamonds at the foot of your chart and tells you what is likely to be happening with the cycles. That's the analysis part of Hurst cycles. When you want to start trading it, you have to adopt a trading methodology. You choose an approach to trading it. Hurst's methodology was basically when you know that cycles are approaching a trough, then you look for long trading opportunities for an indication that the price has bounced out of that trough. When you get confirmation price has bounced out of that trough, then you would enter into your long trade. So Jorge is speaking about getting into a short trade because, of course, according to this analysis, we have an 80-day cycle trough expected pretty much this week or perhaps next week. So sometime within the next week and a half, within the next 10 days or so, we are expecting an 80-day cycle trough to form, which means we're expecting price to come down into that 80-day cycle trough. If you're looking to enter into a short trade, you would be looking to benefit from the move down into that 80-day cycle trough. I must point out that as we get closer and closer to that 80-day cycle trough, we need to also stand by for the fact that that trough might be a very shallow affair. It might just be a very quick little trough, and then price will bounce back up again. The average length of an 80-day cycle is 68 days, and you can see that as of today, that cycle, if it has been running since the end of August, has been 68 days. So that 80-day cycle trough should be upon us. It is possible that price will hardly move down at all into the 80-day cycle trough. If the alternate analysis that I showed you a moment ago, and let's just go back to that chart, it's quite an point. If this analysis is the correct one, let's leave that composite model line on, that's quite interesting. If this analysis is indeed the correct one, then what we're going to expect to see is price coming on into only a 40-day cycle trough. But at the same time, and the 80-day cycle trough is going to occur later in December. Now, that points out a very useful aspect of Hurst cycles. Even if your analysis is wrong, or if you have 2 different analyses, you'll find that you're still often trading in the right direction. Usually would be interested in a short trade coming into a 40-day cycle trough. But if this is the 18-month cycle trough here at the end of September, it might not be a very big move. Why? Well, because you've got so many cycles pushing upwards. Remember that after these troughs, these cycles are all pushing up. You've got the 18-month pushing up, the 40-week pushing up, the 20-week pushing up, the 80-day pushing up. All of those 4 cycles are pushing upwards. Okay, and so it is possible that price will only move down a very small amount into the trough that is expected this week. Doesn't matter which analysis we're looking at, the trough, there is a trough expected this week. It might be of 40-day magnitude, or it might be of 80-day magnitude, or some analysis might even have it as 20-week magnitude, although that seems very unlikely at the moment. But look at this composite model line. Can you see how little it is dropping down? That is because the cycle information it has indicates that the move down into the 40-day cycle trough is likely not to be a very impressive one. The move down into the 80-day cycle trough will be a more impressive one, but still not really, the big drop many people might expect it to be. It's a very important aspect of Hurst cycles that the troughs that form in the markets don't always look as big and impressive as you would expect them to be because of the magnitude of the cycles. That's because cycles get distorted because of all the longer cycles. But to get back to Jorge's actual question, which was, how would you make an entry into this market? So let's go back to this analysis over here. There are various ways of making an entry, and the way that I like the best is to use the FLD, which is the future line of demarcation. I have used and still use to this day a trading methodology that I developed, which I call FLD trading strategy, and it answers that exact question that Jorge has just asked, which is, how do you know when you should enter into a particular trade? And what I do is I trade this line. This is the future line of demarcation, the FLD. Not a very complicated line to calculate. You can do it yourself at home. You simply have to get the correct wavelength. That's the tricky part. You have to get the correct wavelength for the 20-day cycle, and you displace the median price forwards by half the wavelength plus 1 bar as a matter of interest. And this line gives you the entry level. So can you see how this line provided support for price over there? That's the important point. And if you do trade using the FLD trading strategy, you'll know we spoke about it last week. That looks to me like a B category interaction between price and the FLD, where price comes down to the FLD and it finds support. Then we expect price to pull up above the FLD, which would have been the C category interaction. We are expecting a D category interaction next for this drop into this nest of lows. The labeling I'm using here is assuming this is a 40-day cycle nest of lows, and so I should be using the other chart, but that would be a D category interaction. And so finally, to answer Jorge's question, the level at which I would be interested in entering into a short trade is the level of that 20-day FLD. That's the answer to the question. It took me a long time to answer it, but that is the answer, using that methodology. However, Jorge, I must caution you that if the alternate analysis that I've just presented, which is this analysis, which is a very valid, very viable analysis, if this is the analysis, there's the 20-day FLD on that analysis. If this is the correct analysis, then price is only coming down into a 40-day cycle trough. See the list of lows over here, which is expected this week. Here you can see in the composite model line that the actual cycles that are going to cause that drop aren't expected to be very impressive. And in fact, let me just quickly see which cycles. Let me add that in there. There we go. We get a bit more of a drop if I in 20-day cycle, which at this level, of course, we should. So here we do get a bit of a drop, but it's not a very impressive drop. Can you see that? I mean, you might be able to grab a quick short trade out of it, but it's not very impressive. So you should maybe be a little careful. This analysis looking at on this chart, there are many things that make sense to me of analysis. In particular, the way in which this composite model line, okay, which is a brown line that you can see on the chart, the way in which this brown line has reflected fairly accurately the recent price action, and in fact, I'm sort of scribbling over this chart without making any sense. If you look at how that brown line has reflected price action really very accurately over the past 2 months or so, it increases my confidence in this analysis. which means that, yes, I've been speaking for a while about, the drop into the first week of September, of November. But now that we get here, I'm wondering whether it's going to be such an impressive drop. I would probably, obviously it depends on your time frame, but I'd be inclined, if you're trading on an end of day basis, I'd be inclined to step back and not jump into that short trade. Perhaps you could use other methods. The FLD trading methodology is not the only one, of course. You could, for instance, use the 20-day VTL. Now, the VTL, as you can see, is very close to price. Some people would use the VTL as a way of determining their entry. Price has already, in after hours or before hours trading today, has dropped down below that VTL. So you've missed that opportunity, but perhaps you might want to set an entry at last week's low if you are expecting the drop to be a little more significant. Okay, I'm trying to catch up on the questions that I've missed. Paul, where does the composite model line? And let me actually just switch windows so that I can see these more clearly. Right. Where does the CML start drawing from, the composite model line? Where does it start drawing from? The composite model line, I think I saw Sam answer that. Gosh, there's so much going on in this chat window. CML, where the analysis period starts. That's absolutely correct. Sam, of course, should know that as our head of support. Okay, so if I zoom all the way out, you can see here, Paul, the composite model line starts where our analysis period starts. In fact, it starts at the first identification of a trough in the analysis, and so the composite model line is actually rooted to this point over here, way back in 2006. Okay, so here you can see the composite model showing us. It doesn't show us the projection. It doesn't show us what the analysis is projecting. It shows us what the cycle information tells us was happening. In other words, we are reconstructing all that cycle information, and we come up with that line. You can see that cycles provide you with a lot of information in terms of what the markets are doing, but cycles aren't perfect. So if we zoom in on this period over here, our composite model line, our cycle information was telling us to expect price to drop, but in fact price dropped a lot quicker. You can see it pulled away from the composite model line, and the reason for that, of course, is because price movement isn't constituted only of cycles. There are lots of other things happening, in particular emotions, which can't be explained entirely. And so over here, our cycle information, broke away quite dramatically from price. I don't know if you remember that period of time in late 2009. I remember it quite clearly because price just kept going up and up and up. And of course, according to our cycles, we expected more of a pull down in price. So it's an example of how price isn't constituted only of the cycles that we follow. Okay, and so another question from Robin. ST is facing a 40-week trough on September 28 for CAC 40, DAX, and Nikkei. Can we use commonality to increase our confidence on that date? Yes, Robin, absolutely. Commonality is a very important concept, in my opinion. The principle of commonality states that markets tend to move with a great deal in common. Let's see, I don't have any of those. I don't have any of those workspaces open. Interesting to look at commonality, and in fact, I do plan to webinar where we really concentrate on commonality, and I have a guest lined up who's going to come and join me on that webinar, and we're going to discuss analyses of various markets, including Chinese market, Shanghai, and we're going to speak about commonality. We're going to focus. So the simple answer to your question is yes, definitely you can use commonality to increase your confidence in that date. Absolutely. What will tend to happen is that is that one market or the other will move with a great deal of emotion, and the U.S. markets, the U.S. markets did that. What chart am I looking at here? The U.S. market did that recently at the end of August. That was a really strong emotional drop, and when you see something like that happening, it's not all the cycles. It's not only cycles that are causing markets to go down. There's a lot of emotion happening there as well. So I hope that it didn't really answer that question, but yes, I think commonality is very important. Okay, so Vigantus is asking about the MT4 program. Yes, absolutely. We are developing plugins for many trading platforms, and we will be making announcements about that. It's very exciting. It's still a few months away. Okay. Right. And any other questions there? No. Okay. So there we go. That is an interesting alternate analysis, I believe, in the S&P 500. And it's not very different to the analysis that I presented last week. But it does also, like that analysis, warn us a little careful of going into these short trades here, because we might need to wait for this correction to complete. Important point to summarize, I believe, in terms of the S&P 500 and the ES, is just to reiterate that all of the analysis alternatives that I have looked at indicate that we might, or that we should get a really important peak in January of 2016. Depending on your time frame and how much you want to get into and out of the market, certainly January of 2016 is going to be a very important time to stand and potentially really start thinking seriously about trades in January of that year. Patience is a tremendous virtue when it comes to trading. And one of the problems that many people face, I believe, in trading nowadays, they open their trading accounts and they want to enter a trade tomorrow. What trade can I get into today? And it's very important to wait for the correct trading opportunity and then take advantage of that when it comes along. So all of our different alternate analyses are basically highlighting January 2016 as a very important turning point for the peak. The only difference is in how price gets there. According to this analysis, we're going to have a very small little correction now in November, then more of a bullish move, as you can see, then a bigger correction in December, and then the final up into January. Some of the other analyses, have a bit of a sort of a downward spiral, but nevertheless, January 2016 is an important day to watch. I would like to, if there aren't any specific questions around that, I'd like to quickly take a look at gold, which was what I planned to speak about in today's webinar. And of course, as always, running a little bit late. Let me just check if there aren't any other questions there. And if I switch windows, which seems to cause... okay. All right. And I see Ventus is speaking about different trading platforms. To develop the plugin for TradingView. Okay, we are developing plugins for several different platforms, but we'll definitely have a look at that so that we can bring her cycles directly to your trading. Let's take a quick look at gold. And when we last spoke about gold, I had John as a guest speaking on our webinar, and he presented his opinion about gold and what it was doing. And so I'm really just going to update the analysis that we spoke about from that webinar. John presented the slightly different nominal model that he uses to analyze gold. I'll quickly show you that nominal model. Now, if in Sentient Trader you use the analysis menu and go to nominal model, and you can edit the model that's being used for this particular chart, then you can see the nominal model that's being used. if you have other Hurst cycles analysts that you collaborate with and you share workspaces, then if you open one of their workspaces in your copy of Sentient Trader, then Sentient Trader will store that nominal model for you so you can use it on your own analyses, which is a really nice way of very quickly and very easily sharing nominal models. And so John shared his gold analysis with me, and so I have his nominal model. And you can see the longest cycle here is 14 years, 13.9 years, as opposed to the normal nominal model that we work with on stock markets, which is usually considered to be 18 years long. And here is the second cycle, 7 years, and then you get a 42-month cycle, and so on. I won't go on too much about that, but is using the different nominal model that John created for the analysis of gold. Now, I'll just repeat, there's a very interesting post on the Hurst Cycles website. If you haven't read it, please go along to hurstcycles.com and take a look at the post written by Gary Martin about revisiting the nominal model, in which he suggests that markets have changed their behavior, possibly since 1987, perhaps the early 1990s. They have changed the way in which they behave, and therefore we should be using a different nominal model, particularly when it comes to longer cycles. So that's a really interesting post to take a look at. And of course, you can very easily adjust your nominal model in Sentient Trader. You can quickly build a new nominal model and analyze your markets using a different nominal model. As a matter of interest, the approach that John used was that he had Sentient Trader perform its analysis using what is initial cyclic model instead of the nominal model as its basis. And we've had a few questions about that, so I'm just going to quickly speak about that process. Not in too much detail because we could take quite some time. Let me just bring Sentient Trader's window down so that you can see the toolbar. Okay, over here, right up at the top, there is a button in the toolbar which has the letters NM on it. And that means that Sentient Trader is favoring the nominal model in its analysis process. So let me just explain what that means. The alternative to NM, to nominal model, is ICM, which stands for initial cyclic model. So what happens is Hurst recommended that when you perform your analysis, you first of all take a look at the results of a form of spectral analysis on the data. And Sentient Trader performs a form of spectral analysis. I can never find it anymore. There we go. And here it is over here. And the results of that spectral analysis are presented in the same way that Hurst presented them, using a periodogram, which is a fairly old-fashioned way of presenting these results. There are more modern ways of doing it, but Sentient Trader, really sticks to the way that Hurst did things, because I think that's quite important. And so there are the results of the spectral analysis. And using a periodogram, the way in which this works is that where you see fairly high peaks in the spectral analysis is where there is evidence, strong evidence that there are cycles of that particular wavelength active in the data. Of course, there are lots of those peaks because there are of course, lots of cycles in the data. But that's the result of the spectral analysis. Then what Hurst recommended you do is you take a look at that, and you could say to yourself, let me just clear this. You would say to yourself, in fact, let me turn off the pen and switch to weekly. It'll be much easier to work with the weekly chart. Here we go. The results of the weekly analysis are quite a lot clearer. So the results of the spectral analysis over here show drawn over it, so you can't see it at all, but it shows about a 33-week cycle has found is present in the data. And quite simply over here you get another cycle which looks about 65 weeks perhaps. Okay, those are weeks. So the results of the spectral analysis tell us that we should be looking for cycles of about 33 weeks or 65 weeks. So there are two approaches really at that point. When you start performing an analysis, you are trying to identify the troughs of the various cycles. The one approach is to take the results of your spectral analysis and start looking for 33-week cycles in the data, and you perform an analysis on that basis, 33 weeks and 65 weeks. The alternate approach is to use the nominal model and say, I know that my nominal model that I'm using tells me to expect 20-week cycles and 40-week cycles, okay, as opposed to 30-week and 65 weeks. And so then you perform your analysis looking for 20-week cycles and 40-week cycles. We generally recommend that users of Sentient Trader try both approaches, because there isn't one correct approach. They're both correct approaches. Obviously, they will provide you with slightly different analyses and different wavelengths. So the best approach really is to perform one analysis, then perform the other analysis, and compare them and see which one is best or better. And so that is exactly what John did when he was analyzing gold. He did analysis on many different price data series. I think I'm correct in saying some of them were gold prices, gold miners, and silver. And he performed an analysis using the initial cyclic model, which means that it lets Sentient Trader go out there and actually see what cycles it can find, rather than necessarily specifically dictating to Sentient Trader which cycles it should find for you. Having performed analysis, he took a look at the results and he built the nominal model that is now used in this particular analysis. So we had quite a lot of questions about that, so I hope that answers those questions. So what is happening to gold? Well, you will know if you looked at our webinar a few weeks ago when I spoke to John and we considered gold, you will know that he was speaking about the formation of a very long cycle trough, which has either just occurred or lies just a little bit into the future. So here are the two options. And if I really zoom in, you can see here, this analysis indicates that the very long cycle trough has formed, and that it formed at the end of July. There it is. So that's a trough, I can say, of 7 years. And I believe it might even be a trough of the longer 14-year cycle that that John uses for this analysis. I don't have a very long data series that I'm analyzing here. So we're looking for a really long-term trough market. Now, according to this analysis, as you can see, that trough has occurred because Sentient Trader has found it there. But before you start getting too excited and saying gold has definitely turned around, we have to consider the correctness of placing that particular trough there. There is an alternate possibility, which is that we still have a little bit longer to wait until that trough forms. And here is that possibility. And I've been watching this, and you can see I've had to actually sort of pin these troughs here to prevent Sentient Trader from really identifying that very long cycle trough. But as you can see here, the long cycle trough is still expected, but it's expected only in a few months' time. When cycles approach very, very big magnitude troughs, you have to be very careful of jumping to the conclusion that the cycle trough has to look at the analysis more carefully. I see David Trading Hurst says he thinks this is a better analysis than gold. Okay, so I think it probably is as well, and I'm going to show you a very interesting point that John made, and that is that we need to take a look at the, where's this chart here? We need to take a look at the 30-week FLD, and let me not do it on that chart just for now. Let's do it on this chart here. We take a look at the 30-week FLD, because we don't want to jump to the conclusion that that very long trough has formed until price successfully gets through the 30-week FLD. I think I'm correct in saying. I can see John is here, so hopefully he can point out any errors I'm making in the interpretation of this analysis. But I believe that the 30-week FLD is a very important line to watch. And can you see what has been happening with this 30-week FLD? If you'd watched our webinar about gold, you would have known to watch this FLD carefully, very closely. And can you see, in fact, I'm going to zoom right in so that we can see this in detail. Can you see how price has reacted to that FLD? It has come right up to the FLD. It has found resistance at the level of the FLD. Last week on Wednesday, it popped up briefly for a very brief period. It popped up above that FLD, but it is now dropping down away from it. Okay, so so price has not yet successfully breached that 30-week FLD. And that was one of the conditions. I see John's just posted a comment. The 30-week is the one to watch now. So you don't want to assume that gold has turned around until it is FLD, and it hasn't broken it. Can you see how important those FLD lines are? I love FLD lines because they are like they're like lines drawn in the sand. You can, when price comes up to an FLD, price is going to do something. It's either going to find support or resistance, or it's going to burst through that line. And the fact that we were watching it and that line has clearly provided resistance gives us a cause to suspect that the analysis that we're looking at here is not indeed the correct one. I'm sorry, is probably the correct one, and that we still have to wait probably a few months until the very long long cycle trough forms in the market. I've been speaking too long. I'm beginning to lose track of sentences. John says, looking at the gold trader report data, it would suggest a further test of the low seen in July. Okay, so again, that seems to be the general consensus that we should be standing by definitely for that very long cycle trough to form in gold, but we are probably looking at a new low below July's low, and another few months, I beg your pardon, until that very long cycle is in fact form. And Yurian says, using default analysis, the FLD 30-week has been broken. Yes, let me get back to that. That's very, very important. But a very quick question from Robin Bailey. What's the first day of the analysis? Let me just have a look. What is the first day of the analysis? Okay, I'm analyzing all the data I have, Robin. So as I've mentioned in previous webinars, I will usually just perform an analysis, and if it looks good, and by it look good, I mean that the big cycle troughs are lining up in the correct places, and the big cycle troughs are lining up in the correct places in this analysis. So I haven't actually changed the first date of my analysis. You can see is that the 4th of August or the 8th of April? That's the 8th of April, I believe. I'm not sure which language this computer speaks. No, that would be the 4th of August. Yeah, the 4th of August, of course, because it's coming up until November. 4th of August 2004 is the analysis start period. Bob's asking to see the CML, and let's do that. Here is the CML for this particular analysis, and that's the composite model line for those of you who aren't with the latest lingo. And here it is over here, and the composite model line does, you zoom in, I've spoken about that before. Here's the composite line looking very good and really accurate, and it's indicating a low here in March of next year. Can you see what happens after that low? Okay, the market just turns and heads straight up. So that is the big turn that John was speaking about in the webinar that we held a few weeks ago, where we spoke about gold. Let me get back to Yurian's comment about the FLD has been broken in the default analysis, because it's a very, very important comment, and I showed it to you a moment ago, and then I moved away from it because there's something to explain about that. You must remember the cycle tools, the FLD and particularly the VTL, are drawn on the basis of the analysis that is on the chart. So if your analysis is not correct, then your cycle tools, the FLD and the VTL, will of course also not really be correct, okay? Because they're based upon your analysis. So you end up being in a bit of a catch-22 situation because you're using your cycle tools to perform your analysis, but if your analysis is wrong, your tools will also be wrong. So there's a really subtle art to this. I know I keep going on about analysis being an art, but I think it is. I think Hurst cycles analysis is as much an art as it is a science. But let me quickly show you the point Yurian was making. Here's the 30-week VTL using this analysis, which most of us seem to agree is the preferred analysis. The big trough that we're expecting in gold still lies ahead of us. And I pointed out how closely it came to that 30-week FLD. Okay, there it is over there. Price found resistance at the FLD. Now, you must remember that the FLD is based upon the analysis that the software has. And to calculate the position of the FLD, it uses the recent wavelength of that 30-week cycle. Now, the recent wavelength of that 30-week cycle you can see is presented here at the bottom right corner of the chart, and it is 33.3 weeks using this analysis. Now, if we go and take a look at the default analysis, which is pretty much this one here, which has the very long cycle trough in place, and plot that 30-week FLD, do you notice something? Price has crossed through that FLD. It did it over there. So the question is, which FLD is correct? And the answer to that question lies in the fact that the FLD is determined by your analysis. So the correct FLD will be the correct analysis. So we have a rather complex puzzle to solve here. Which one is? There are various ways of resolving this. One way of resolving it is to look at the recent wavelength of that cycle, which here you can see is 27 weeks. So that indicates that recently the 30-week cycle has been running short at 27 weeks. The next thing you need to ask yourself is that likely? Is it probable that that cycle has been running short? Maybe it is, maybe it isn't. That's something that you need to decide for yourself when you have a look at it. The other very important thing to realize is that that 30-week cycle has been found to be running short because of the fact, and let me zoom out a little bit, it's been found to be running short because of the fact that the software has positioned the long trough over there. Because it has positioned there, because it has positioned the long cycle trough over there, it has calculated very simply that the 30-week cycles to get there had to be short. Therefore, the 30-week cycles are short. So one way of looking at it is to ask yourself whether that's likely to be true, that the 30-week cycle has been running short. Another way that I like to use, and in my opinion this is a more useful, is you have a look at the way in which price interacts with the FLD. I know I go on and on and on about price interacting with the FLD, but FLDs, when they are drawn correctly, are very important, and price responds to them. So if we have a look at this chart, you can see that price crossed up above the FLD. It didn't achieve the target for that loss. Okay, so that's a point against it. It sort of rose up a little bit, and then it came down, and it didn't do anything. That is not a good, accurate FLD. It doesn't look good to me. I hope you can see that. The picture just isn't right. Price, wasn't really strongly affected by that FLD. It isn't achieving targets and so on. Now, if I show you other analysis, which is this one here, can you see how clearly has responded to this FLD. Not only here, but previously. And in fact, let's just zoom out a little bit, show you the history of price interacting with this FLD. We can go back forever, but let me just go back this far. Can you see how way back in June of last year, price came up between the 30-week FLD, found resistance and bounced down again, came back here, found resistance, came down and dropped down. Okay, that is the way in which price should and does interact with FLDs. You can see over here the way in which price has interacted with this FLD. In my opinion, is a fairly clear indication this is a better placement of that FLD, therefore probably a better analysis. Okay, because if price is reacting to the FLD in this way, it indicates that there's something that is correct about this analysis. I know it sounds a bit like an endless puzzle. You have an FLD informing your analysis, and the FLD is based upon the analysis. That's what Hurst cycles analysis is all about. You do have to solve an endless convoluted puzzle. Losing track of my word. Okay, you do have to solve an endless convoluted puzzle about how all of these cycles work together. But a very strong indication, in my opinion, that an analysis is correct is when the FLD behaves in that way. When you see price reacting to the FLD, that tells you that your analysis is probably a better one. Okay, so Vito, when you get a chance towards the end of the webinar, could you please show the 40-week FLD in the analysis we follow for the S&P? Yes, okay, we'll definitely get back to that. Let's just finish with gold first. John is saying a low by November the 9th and a strong rally would confirm the default analysis. Otherwise, a failure suggests something more bearish into year-end new year. Okay, so that highlights a really important point. When you're working with Hurst cycles and a Hurst cycles analysis, you don't just look at the analysis and say, okay, that's it, and and just sort of make your trading decisions in an unthinking way on the basis of the analysis. What you have to do all the time, and I keep saying this in so much of our educational material, I keep saying you have to question the analysis, and you have to ask, is this analysis correct? This analysis is looking pretty good to me. As John points out, we're expecting a low sometime by about November the 9th, so probably a low sometime this week in gold. And then we're expecting a bit of a bounce up, okay? If we get a failure, in other words, price continues downwards, then this is certainly the correct analysis that I see in the chart here, and that indicates that gold has a big cycle trough coming up ahead of us, something to look forward to. So we shouldn't be jumping into those long trades just yet. And Bob asked to show the GDX analysis. Yes. Perhaps did I tell you I had a GDX? Perhaps you saw it when I pulled down. Let me show you here. I have GDX. It's not a very well thought out analysis, I must tell you. I just quickly whipped it together just before today's webinar. I wasn't really planning on speaking about it, but as you've asked, here we go. So this is an analysis of GDX, the ETF. And let me just do this. You can see in this default analysis, the big long cycle trough has also been found to be present. But that's no surprise. Okay, if we fiddle a bit with this analysis, then we could tell Sentient Trader to perhaps position that trough a little bit later, and we can experiment with that. And let me just show you the 30-week FLD on this chart and see what's happening here. So here again is a very interesting thing happening with the 30-week FLD. Price has come up to the 30-week FLD, and if you wondered why price moved down so strongly last week, could you have Could you have known that that would happen? Well, if you've been watching this FLD, you might have, yes. You wouldn't have known, but you might have had a reason to understand why price dropped fairly strongly last week. It is probably because of that 30-week FLD. So that's a quick look at GDX. I must say this is not a very well thought out analysis. I just started playing around with it before the webinar, but you know, we can play around with this analysis and see whether we can maybe position some of these other cycle troughs in different places and see what Sentient Trader does with it. See if it'll move that trough around, and we can explore that analysis in more detail. And so let's see. I've missed a whole lot of comments there. David, trading Hurst, I think in Hurst cycles you have to build up a balance of probabilities based on the cyclic tools. Absolutely. It is. It's all a matter of probabilities. There are very few certainties. It's not black and white. That's why I enjoy speaking about it so much. You know, you can carry on speaking about it for ages. Very fascinating process. Louis, how does the nominal model for gold differ from the regular model? And I think Sam has sent you a link. Yes, there we go. Okay. David, trading Hurst, if this analysis is correct, the bounce from the 20-week coming should not breach that recent high, I don't think. Okay. 20-week VTL could be a good short. Let's see if I go back to that chart. Where were we? 20-week. Let's have a look and see what VTLs I've got here. 15-week, 53-day. So there we've got the 53-day VTL. I'm not sure I got the full context of that point, so I won't go on about that. Okay, and Bob's interested in the GDX today. Clearly, let's have a look at the GDX, the CML. All these. There we go. Okay, so there's a really interesting thing. That's right, I didn't notice that. So there is a really fascinating thing that is happening to the composite model line in the GDX analysis. And there are various reasons why it is happening. But it shows you, I believe, I'm just taking it back so we can get a bit of perspective on it. It shows that, see, David's saying the point he meant was the 20-week VTL forthcoming. Yes, which isn't on our chart yet. Okay, so here's the composite model line on the GDX analysis. And this raises a really interesting point, and it's a great thing to speak about quickly. That is, I see Elizabeth is on the way. Thanks, Elizabeth. See you in 2 weeks' time. Yes, no webinar next week. Okay, so here's the model line on our GDX analysis, the ETF, and you can see that the analysis shows the long cycle trough occurred here in September in the analysis. It's not the long 14-year or 7-year cycle, because I don't have that much data for GDX. I've got data going back to only 2006, so it hasn't actually included the 7-year cycle in there. But an interesting thing has happened with the composite model line. You can see that the composite model line shows that in fact analysis has been quite accurate. It quite accurately reflects price movement. Recently there have been a few discrepancies, but generally the direction in which the line is moving at each point is correct in terms of the direction in which price is moving, and that's the important point really. But the composite model line, which remember is just a result of combining all of the cycle information that we have because of the analysis, the composite model line indicates that in fact price is expected to continue down to another low over here sometime next year. It's a little bit later next year, about the middle of next year. And so that's really very, very interesting. despite the fact that the longest cycle that it has in its analysis has been phased to have a trough in September, I think it was. So why is that? Why is the CML projecting such a prolonged drop down into next year? The answer has to do with Sentient Trader's calculation of sigma L. Sigma L, remember, is the sum of all cycles longer than the longest cycle that has been found in the analysis. And when the CML, composite model line, shows us something that doesn't really reflect, what should be happening in terms of the cycle model that you can see in that analysis, sigma L is the answer. So what has been happening undoubtedly with sigma L is that sigma, and we can take a look at sigma L in a moment. Let me see if I can pull it up here. What has been happening with sigma L is that, let me see if I can show that line. Here it is. I don't know if you can see that line, Mike. Really dark. Can you see that line on your chart? I hope you can. Let me just draw over it, actually. Sigma L has been calculated. It's a very slow moving line, and Sentient Trader uses quite an advanced algorithm to calculate what sigma L is doing. But this is the very slow moving line, and you can see that it's been pushing downwards recently. One of the reasons that the CML is considered to, or is being presented as moving down in the near future, is because sigma L is still currently negative. So even though our longest cycle found in this analysis, which is a 42-month cycle, even though that potentially has formed a trough, the composite model line is indicating that there is further downwards to go because of the strength of the pressure of the sigma L line. Okay, I hope that makes sense. Pete, just to clear my understanding, the future CML does do a continual redraw. Is that a true reflection for how its present accuracy of future points will be? Yeah, you must remember that the CML is a result of combining all the cycle information that the software has. And what it does is it takes the information that it has about the cycles recently. So, let me zoom in here and show you. And let me just turn off the cycle lines. So recent information that we have about these cycles are, for instance, this 18-month cycle from this trough here to this trough here. Sentient Trader looks at that cycle and it measures its amplitude, and it also measures its wavelength. Okay. Sentient Trader also knows what the average wavelength and the average amplitude of all of these cycles is, or has been, I should say. And it then assumes that the wavelengths of these cycles, and let me see if I can show you that. There we go. It then assumes that the wavelength of cycles will return to the average. So you can see that here I've drawn what's called the cycle line for that 14-month cycle, the yellow cycle in this. And here you can see cycle line, and you can see here we had quite strong amplitude for that 14-month cycle. Here we had lower amplitude for this iteration of that cycle, and here we had even lower amplitude. You can see the amplitude of that cycle has been diminishing. So what Sentient Trader did in order to build the composite model line is it assumes that that cycle is going to return to average, because that's really the only assumption it can make. Of course, in reality, that cycle might continue to get shorter and shorter and lower amplitude, but we don't know that. So the software assumes it's going to return to average, and at some point it will get back to the average wavelength, and then it assumes it continues beating with that average wavelength. So that's what the composite model line does. It's very important that it's not really, yes, it's presenting a future projection, but what it's actually saying to you is if these cycles continue beating with the rhythm they're beating at now and the amplitude that they're beating with, and gradually return to average, then this is what you can expect. Okay. Of course, the paradox is, know that cycle wavelengths and their amplitudes are constantly varying. So cycles are constantly getting longer and shorter, and their amplitudes are constantly getting bigger and smaller. But generally, and you can actually see it on this chart, you can see how the 14-month cycle amplitude has been gradually diminishing over that period of time. So it's not a completely arbitrary random variation, but there is constant variation in these cycles. And so putting together a composite model line that extends into the future, it's very important to realize that it is based on the idea that these cycles are going to return to their average wavelengths, which of course they might not do. And we know that they are going to vary. We might be surprised by the next 14-month cycle and find that it's a strong, big amplitude cycle, in which case the composite model line wouldn't have correctly reflected that amplitude. It should fairly accurately reflect the wavelength, unless, of course, we get a very long or a very short, an unexpectedly short, unexpectedly long wavelength, in which case your composite model line will be inaccurate, obviously. But that's the paradox of cycle trading, isn't it? We know that these cycles beat regularly, and we use them to make decisions, but we also know that they vary in length. That's the paradox, is, to what extent are they going to keep being regular, and to what extent are they going to vary? Fortunately, generally, the amount by which they vary is small enough that it doesn't cause us to take trades in the wrong direction. Generally, as a Hurst analyst, if you're getting your analysis fairly correctly, you're taking trades in the right direction. You might be disappointed by the move that you're trading, or you might be pleasantly surprised. That's generally what variation does. It either surprises you pleasantly or disappoints you, but generally you're not trading in the wrong direction. I hope that answers that question. John says it raises the issue of where the status of very long cycles are. I think that comment when we were looking at the sigma L line and talking about sigma L, were we? Yes, because of course the sigma L line, and I'm sorry that line is so faint, I really don't know if you can see it. Generally the sigma L line does include the status of those longer cycles, and I think in some ways you can see it here. You can see how, in fact, the sigma L line develops a little bit of an M shape all of its own. Because of course sigma L includes all of the longer cycles than the longest cycle that we have in our analysis. Right, I think it's time for us to wrap up. Let me quickly get back to Vito asked, what was it, to look at something in the S&P 500. Let's look at the 40-week FLD. Here we go. Let's quickly take a look at the 40-week FLD before we start. And there is the 40-week FLD. Now, really interesting thing to look at. Thanks for mentioning it, Vito. Price has come right back up to the 40-week FLD, I beg your pardon, according to this analysis, which is the alternate analysis that I presented earlier. And you can see here how the 40-week FLD was proving to be a very important line, and it provided support to price right up until that time in August, where price dropped down below it. And dropping down below the 40-week FLD proved to be, the last straw for the US markets. And I've been writing some blog posts where I've been looking at the 40-week FLD, and I pointed out the importance of the 40-week FLD line, and I indicated that when that 40-week FLD line was broken, it was going to be a very strong sign that the markets had started turning downwards. And of course, I believe that is what we're seeing. Markets are bouncing up to a new peak. They keep going up and down, but I would be surprised if the May peak proves to be, a really big, perhaps even 9-year peak. Will price exceed that May peak? It might do, but only slightly. And of course, January 2016 is be the time to watch for the big turndown, the next turndown, I believe, in the US markets and stock markets. And John doesn't like the position of the 40-week FLD. Okay. I'm not sure if that's a personal thing or whether it's this analysis. Let's take a quick look at the FLD in the other analysis, because of course the FLD, as we've already mentioned today, the FLD is based where it is on the basis of the analysis that you have on the chart. So here we go. This is the other analysis. You can see the FLD is not very strongly affected by the analysis. It is affected. I shouldn't say that, but it's not affected as strongly as the VTL, for instance. Okay, so here's the 40-week FLD, which is likely to provide some. Remember what I've said so many times. FLDs always give price something to think about. Generally, if an FLD is in the correct position, then when price gets to the 40-week, or any FLD, when price gets to an FLD, generally it gives it reason to think or hesitate, pause, perhaps turn around again. John, only to say that the 40-week in the previous analysis looks like it would be resistance, exactly. So I think it's the 40-week FLD is very likely to provide resistance. It's a really important thing, keeping an eye on your FLDs, because FLDs always provide levels of support and resistance. They are, I've called them dynamic levels of support and resistance. That's exactly what they are. If you can look at all your FLDs, then you have a very good way of sort of mapping out what the markets are going to do. You can do really sort of silly things like plot all of your FLDs onto the chart, and then try and work out what's happening there. But anyway, on that point, I think it's time for me to bring an end to today's webinar. Thank you so much for joining me. Just a reminder that, of course, I am not doing a webinar next week. I mentioned it earlier, but just a reminder, I'm not doing a webinar next week. I will be traveling, and I will be in Rome, so I won't be able to do a webinar next week. But I will see you in a week's time. I look forward to seeing you in 2 weeks' time on the 16th of November. And I won't be meeting with the Pope. Anyway, so I look forward to seeing you in 2 weeks' time. Thank you very much for joining me this week, and of course I wish you profitable trading, and look forward to seeing you in 2 weeks' time.